How does the RDTOH, or Refundable Dividend Tax on Hand, work? This is for if you're passive investing in a corporation. How do the layers of tax and refunds and gross ups, how does that all work? I'm going to attempt to communicate the impossible with you. So here's what we're looking at. If you have an operating company, this is basic corporate tax. In Manitoba, we got a 9% small business corporate tax. If you're less than $500,000 in passive income, you're going to earn money. 91 stays in retained earnings, 9% goes into the garbage. Now, when you draw this money out, you take it out as a dividend, you're going to pay tax on it as personal tax. If you draw it out as income, however that works, you do pay tax. You have a corporate tax and an income tax. But if you have an investment and you have passive income, so what's going to happen is half of that money is going to go and get taxed. So if you make $100, $50.67 goes to tax. More than half, okay? If you make $1 or $100 or $100 million, the percentage is the same. It's not a marginal tax rate. You're going to pay just more than half in tax. Now, where does that go? Of the 50% that gets paid to CRA, 12% is provincial tax. And that provincial tax, you'll know, is never refundable. That's in the garbage, compacted, gone, right? The federal, 38.67%. When you look at this, 8% of that is non-refundable. So 12 for the province, 8, that's 20%. You're never getting back. 30.67 is refundable to your corporation, not to you. So this 30.67 we call refundable dividend tax on hand. It's one of the accounts you have of, hey, if I do something that the government wants me to do, they're going to refund the tax I paid. And so it gets stuck. Now, the key to getting this out, this is the key to getting that out. We call it the RDTOH unlock ratio. The unlock ratio is 3-to-1. What that means is if I take $3 out of my corporation, $1 gets paid back to my corporation. So it's a 3-to-1 ratio. So for example, I got to take a non-eligible dividend. Non-eligible dividend has funny rules. You gross it up by 15%, and then you have a 9% credit in Manitoba on the 115. So it comes down to around 12 or so. But on a $90 draw, which is 3-to-1 on this, you're going to pay tax because you pay tax when you pull money out of your corporation. But by drawing this out, what's that going to do is that's going to take this thing and that's going to allow them to stick that back in the company. So here's what this looks like. You earn passive income. You pay 50% tax. 12 goes in the garbage, 8 goes federal, but 30% gets stored in an account that you track on your ledger, on your annual statement. If you take cash flow out 3 times your RDTOH balance, you get that money refunded back to your corporation. Now, here's some things that you don't know. The cash flow, it can't be your first year in business, can't be your last year, because if you make $100 and there's only $49 left, in order to get this back, you need to take an eligible dividend of $90. So there's got to be other monies like any operating company. Then what happens is some of the headaches you might have. Oh, by the way, the total tax, 50% gets paid, 20% is never coming back. This 30% goes back to the corporation. So the corporation ends up paying 20%. If your personal tax bracket is 30%, then you're going to pay 50 in total, 20 corporate and 30 personal is how you're going to pay it.